welcome to ShareTreck. Today is Saturday 22nd of January, and I thought I'll make this video to address the question of how low can the market go. I've been thinking about this for quite a while, and I'm sure all of you have this question in your mind. And wherever you look at it, you don't get a straight answer, and I'm afraid to say that I also don't have a straight answer for you, but you will follow the logic and you will be able to get a feel of what the dimensions of the problem and what to expect, and you will feel much more comfortable looking at what's happening in the market after you finish looking at this video. And that's my hope, because all the information that I put in here gives me much more comfort about my ability to predict how things will go as things unfold in the market. I have tried to address this question in two of my earlier videos. The first one was outlook for CRISPR in 2022, and which was one of our best videos in this channel because a lot of people saw it. The second video in which I tried to address that was market risks and CRISPR. That was a more recent video, but right now I'm going to address one of the aspects that I had not addressed in my earlier videos, and that is the yield curve, and also the dynamics of what the Fed will be looking at as events unfold in the economy, so that we can anticipate how things will go whenever new events happen in the economy or in the market. So with that in mind, let's get started. So the Corporate Finance Institute says that when a flat yield curve occurs, it often signals uncertainty in the market and could make investors wary of making any investments or going long in the market. Often economists and investors will use a flat yield curve as an economic indicator of a potential recession. So this is established wisdom, and this has been the wisdom for quite a while in the markets. And in our case, at this point of time in this market, I think the demographics of the market participants have changed a lot. There are more retail investors as compared to institutional investors. It's not that institutional investors have gone down in number or the hedge funds are down. It's just that there are more retail investors participating in the market than before. And this has been seen in terms of the market action in AMC and a whole lot of similar actions where big institutions have been humbled, and the retail investor has been able to have a focused effect on particular shares. So we cannot rule out that the established wisdom might not persist going forward, but we should assume at this point of time that established wisdom will continue. How do you identify a flat yield curve? So basically, if yield on short-term investments is the same as yield on long-term investments, then the yield curve is flat. What does that mean? So if you were to lend for a small period of time, like 3 months, as compared to a long period of time like 10 years, your small-term investment is going to attract very less risk, because there is just a 3-month window in which bad things could happen, and that's a very small window. Therefore, the yield that you get on a small-term investment is low as compared to the yield that you would get on a longer-term investment of, say, 10 years, because 10 years is a long time in economic terms. There could be many economic cycles that could happen within the 10-year time frame. So your risk window is much wider, and therefore you get higher yield on longer-term investments. So this is the two ends of the investment horizon. When you come into a situation where the yields that you get in the long term is the same as the yield that you get in the short term, that means that the yield curve has flattened, and there is no incentive for anyone to invest in the long-term instrument as opposed to the short-term one, because the yields are the same. And that is what scares a lot of people when it comes to flattening yield curve, because that indicates a change in the mindset of investors and the economy, that new ventures and any further growth is kind of stifled, and that's the kind of inertia that comes into the economy that lends itself to recession. And that's the reason why people are scared of the flattening yield curve. So this is what yield curve would look like on a graph, and you can see that we have a 3-month. See, this particular axis, horizontal axis, is the years, and the vertical axis is the interest rate, and this line shows the correlation. So for a 3-month yield right now is at 0.18%. That is the yield that you get on a 3-month instrument. whereas the yield that you get on a 10-year instrument is 1.75. And therefore, you have this sloping line, which is sloping upward as the years unfold, and the interest rate is going up as the years increase. So this is a normal yield curve. A flattening yield curve would look like this. This is a flat yield curve. And before reaching this stage, what would happen is that the 10-year yield will start falling slowly and slowly until it becomes flat. And when that starts falling down, that is what is called as a flattening yield curve, and that spooks the economy. And before it reaches a stage like this, the Fed and the government, everybody would act in order to stimulate the economy and take measures that will make it better. So why will the yield curve become flat? Because as investor flees stock, and also other countries which have got troubles, they might push their money into the 10-year treasury, US treasury, because it's the reserve currency. And everyone flees to relative safety. They will buy bonds that provide the highest yields. Right now, the 10-year bond is the one that provides the highest yield. So if you look at yield, yield is the returns by the price of the bond. As more and more people start buying the 10-year bond, what will happen is that the price of the 10-year bond will go up and the returns will remain the same. So when you divide the interest rate that is available for the bond by the price of the bond, which is keeping on increasing, you have a yield that keeps on going down. So that's how the yield of the 10-year bond will start going down, and the curve starts to become flat. Like the short term will remain where it is, whereas the long term is going to start coming down. That is the flattening process until it becomes equal. And at that point of time, what will happen is we'll have an economic decline, during which trade and industrial activities are reduced because no one wants to invest in innovations and futuristic products and bringing up new models of stuff, because there is no incentive in investing in longer term. So everything is short term oriented, and generally it is identified by a fall in GDP in 2 successive quarters, and it's called a recession. So the Fed would like to avoid this kind of a situation where we have recession. So as we keep on seeing increase in interest rates, we are coming into a situation where borrowing money becomes more expensive and people find it very difficult to do new enterprises. So it's a very delicate dance, and that is the dynamics behind the yield curve. So where are we now? As you recollect, during the previous administration, we had a $2 trillion tax cut, and later on we had to give a stimulus. I think it was $700 billion or something for COVID relief, and all of that has put a lot of money into the market. So if there is a lot of money into the market chasing the same amount of goods like before, then you can say that the value of money has gone down, and therefore you need more money to buy the same amount of goods. That is the definition of inflation. But on top of that, we also had a low interest rate regime in order to help industries to invest more and create more employment and boost production. The low interest rate has made money cheaper and has also allowed a lot of borrowing activity. Much of the borrowed funds has also gone into the stock market and other places, and many companies have used the cheap money to buy back their own shares, and thus inflating the share prices and fueling a general increase in price and fall in the purchasing value of money. And this again is known as inflation. We also have had the pandemic-related supply chain issues, which has exacerbated the inflation. So if we go back to the first point where I said that a lot of money is chasing the same amount of goods, now if you look at the supply chain issues which are posed by the pandemic and the lockdown, we look at a very, very extreme situation where not only are people not able to move around because it's a lockdown, due to which they need a lot of things at home, which they wouldn't have needed, and also people stockpiling food and other things in anticipation of shortage. That has kind of had one drastic impact on the inflation. The other part is that all the demand that was expected was more than what was normal, and because of the supply chain bottleneck, the supply has not come in. So you have on one hand extreme demand which was not seen before, and on the other hand you have a lack of supply to even meet the normal demand. So both of these together have acted in pushing up the price of goods, reducing the value of money, and that has given us the inflation that we see today. And the other aspect of the lockdown has also been the tight labor market conditions, because many people are afraid of catching COVID, and until the vaccine became much more readily available and the testing became much more readily available, many people are afraid to venture out. So even though we have a low unemployment rate right now, I suspect that a lot of people are still waiting to venture out into employment. So we can see the unemployment rate ticking up a little bit once all these pandemic pressures are over. But that tight labor market also causes increasing salary and operating costs for the company, and adds to the inflation, and kind of puts a lid on productivity increases. Production increases. The productivity goes up, but the production increases are limited, and the ability to satiate the demand for products and services is much constrained, and that doesn't do very good for inflation. So that's where we are right now. So what is the solution, you may ask? So there is a lot of nuance in this thing which we need to understand. That's why I'm going to go point by point. The first thing is we have a prospect of rising interest rates. So the effect of increasing the interest rates will be to mop up the extra money from the market, and therefore, if there is lesser amount of dollars in circulation, it increases the value of the dollars, assuming that there is no increase in supply. However, if on the other hand we have a resolution of the supply chain issues, then we may have more goods coming in and reduction of dollars from the market, and that's going to be a kind of inflation reducing measure. So we are looking at the prospect of rising interest rates, and we want the inflation to be around 2% to 2.25%, which is what generally most governments target. And I think in the United States it's around 2%. And that's what the Fed will be aiming for. Right now we are way above 2%. I think we are around 6% as of the last reading. The Fed and the government need to closely monitor labor participation and supply chain status. The reason I'm saying that is because as the pandemic resolves, there will be more and more people willing to work, and they will come out to work, and that is going to kind of reduce the pressure which is there on the employers, and also the production chain as well as the supply chain within the United States. There will be more truck drivers willing to drive around. There will be more people available to work in the factories, because they would have had the vaccines and they don't have the fear anymore, or maybe the pandemic has become endemic and it's no longer so threatening, and more people will come into the market. So that's the kind of a measure that would dampen the inflation. So the Fed may want to watch and calibrate the interest rate hikes based on increased labor participation, as more and more people come for work, and there is more employment taking place. That's what the Fed will look at. And on the other hand, they would look at the supply chain status, whether there's a shortage of goods still in the market, and whether the supply chain has improved. There are many possibilities. One thing could be that the pandemic is kind of died off, and immediately the supply chain is restored to full capacity, which is the best case scenario. But we all know that our ports are all blocked up, and there's a backlog of processing in the ports of already the goods that have come into the port. And there are a lot of ships which are waiting to come into port and unload the inventory. So that is the situation that we have. So first of all, we need to have resolution of the situation at the port, and I think the government has already done a lot of measures in that direction. And the second thing is that the relationship that various companies had with their supply chains internationally, they might have got altered during the period of the pandemic, which has lasted a long time, almost 2 years. And this is a long period of time for most companies. So they would have developed new relationship in new geographies, and there are new supply chains that are in place. So when everything gets resolved and the supply chain is trying to restore itself, there may be a lot of competition in the supply chain itself, and it may re-establish itself in different configurations. And that may probably provide some relief at the ports and the transportation, and maybe instead of having all the supply chain coming through the ports, we may have some coming through the land, maybe from Mexico or Canada or elsewhere. So those kind of things would take place, and gradually the supply chain will get into a place where it's able to meet all the supply requirements to satiate the demand. And all this thing is not going to happen immediately or in a linear fashion. They may happen in jerks and upward and downward movement, if you were to look at it in a graph in terms of supply going up and down and so on. And the Fed will have to have a close look at it by looking at various economic data readouts in order to calibrate their interest rate plans. And the more important concern at this stage would be to avoid a recession, because if you tighten up the money supply too much and the yield curves kind of get flat, then you're into a recession, and then you'll have to go through the process of pumping more money again, and the prospects of negative interest rates and all those things. We want to avoid that situation, and therefore the Fed will be carefully looking at the interest rate hikes. Also at this stage, we need to be aware of the fact that as and when the Fed raises interest rates, the Fed has borrowed a lot of money, the US has borrowed a lot of money, and then the interest rate will go up. That means the debt servicing costs will go very high. So, and there is that factor also to keep in mind. So we have to make sure that each 25 basis point interest rate hike is really effective, because the more you raise the interest rate, the more the pressure of interest payment on the government. So how is the stock market reacting? So we already see increased volatility in the stock market. Indices have dropped. Our NASDAQ composite has dropped 11% so far. The treasury yields have also gone down. It was at 1.83% at the beginning of the year. It's now down to 1.75. And as more and more investors flee from the stock market and put money into the 10-year treasury, it will continue to go down. And if we have conflicts in the Ukraine or Kazakhstan gets more volatile, there will be more money from international sources coming into the treasury, 10-year treasury bonds, and then the yield will fall down further, thus initiating the flattening yield curve. So if we were to look at the market at this point of time, only energy showed a gain in the S&P 500, and that too, the gain that it has showed, I don't know if it's going to be resilient. You will understand that as I show you the next slide. There are less risky investments such as consumer defensives and utilities, which have just about managed to hold up better than the rest of the market. So if you had to look at the one-day relative performance, 1 week relative performance, and one month relative performance of various sectors of the market, so you would see that consumer defensive is doing better, consumer defensive, utilities and real estate is doing better than all the other sectors in the market, including energy. This is a 1 day, so this is the latest read. If you look at a 1 week relative performance, energy has been doing the best, followed by utilities. And if you look at a 1 month relative performance, energy has been doing the best as compared to all other sectors of the economy. So typically when we have this kind of increasing interest rate regime, you would find financials and banking doing much better, energy doing better, and defensive stock, consumer defensive stock doing better. So that is how the chart will look as we go for longer periods of time, and that's where we are. That's how the stock market is reacting. So the question you may ask is, where is the bottom? It depends on various factors. The first one is, how is the pandemic going to resolve itself? Is there going to be any more variants coming up, or is Omicron going to become weaker and weaker and become like a seasonal flu without any fatalities or without any hospitalization, in which case people can just feel free to go ahead and participate in the economy, both as consumers and as employees, and in various capacities. So that's one first question. And how long is that going to take? Is it going to be a 3-month wait, or is it going to be a 6-month wait, or is it going to take a whole year? The second question is, how will the supply chain shortages resolve itself? Even if we assume that the pandemic is not going away, there is more variant, is there going to be a lot of activity which the market participants have done that creates a situation where the supply chain is now reconfigured itself in the new reality of a pandemic and is still able to meet the demands, and therefore there is no supply chain shortage or bottleneck, right? That is one possibility. The other possibility is that as the pandemic starts resolving, the supply chain starts opening up gradually, and by the time the pandemic has ended, the supply chain is fully restored. So that is the second possibility. But we also have to remember one important component of this supply chain shortage is our capability to handle incoming supply at the ports. And the government has done a few things to ease that bottleneck, but still we do have ships which are waiting to unload their cargo, and we do have a bit of problems clearing the ports and sending out the inventories. So all those things needs to resolve, and how soon are they going to resolve? That is the question, and it needs to be monitored very closely. The third factor is labor market. What is going to happen in the future? Are people going to be, the cautious people, are they going to be fed up of sitting at home and they decide to take the risk, they take their vaccinations and decide to just come out and start working? And how soon is that going to happen? Or is the pandemic resolution going to happen very quickly, and as a result the labor market starts to participate? What happens to those people who have found that they have an epiphany and they feel that life is worth living rather than putting a 9 to 5, and they have started their own businesses or something, and or a side hustle, and they are happy to stay a retired life and they're not going to return back into the economy? All those issues have to be resolved for the labor market in order to see that the participation is at a level where there is no strain in production and therefore no shortage of supplies. So that also is an evolving factor, and all of these will be shown through economic report like the unemployment report, and the level of employment and the level of people who are looking for employment. All those numbers will change progressively, and the Fed will look at those, and that will also determine where the bottom of the stock market is. Build Back Better plan seems to have been abandoned. That would have been a shot in the arm for the economy by pumping in more money, but that would have meant more inflation. So since the Build Back Better has been shelved, more likely, and it may come out in smaller components, the inflationary capacity of that has been reduced significantly, and the inflation may come probably in spikes whenever money is introduced in the market under those schemes. Tapering is going to end by the end of by the month of March, and then we are going to start our initial interest rate hikes in the month of March, and we are expecting 0.25% hike every time, culminating in probably 1 to 1.25% interest at the end of December 2022. So that's what we are visualizing at this point of time. But based on all the things that I discussed earlier, like pandemic, supply chain shortage, labor market, how they evolve, the Fed may decide not to hike the interest rate or hike it much more severely. It all depends on how the data comes in from the economy. There's also this question of whether Ukraine conflict will escalate. If the Ukraine conflict escalated, then there will be more international money coming into 10-year treasuries, and that is going to push the yield down faster, and that will have its impact on the economy as we discussed earlier. Will the oil prices come down? So if we have no major problem in Kazakhstan and that gets resolved, we don't have issues with Iran, then the oil prices are likely to tread their way down, and things will be much better for the economy. However, if the oil prices don't come down, the inflation is still going to be based on the high price of oil, working its way down into the supplies, and so that has to be watched. That's also a key factor. Will the Chinese regulatory regime stabilize? Because there's a lot of Chinese companies in the stock market, and also there's the policy difference between China and the US, and there's this political conflict for dominance. So how is that going to shape up? That's also going to dictate of where is the balance, or where is the bottom of the market. When we come to the Chinese environment itself, what is going to happen to the real estate problems, and how are they going to manage it, and will that be resolved within 2022? All these factors are going to determine where the bottom of the market is going to be and when it's going to happen. Will it happen within 3 months, in the first 3 months of 2022, or will it drag all the way up to December of 2022? So we have to see the way we get market information, the market data as these things evolve, also the news as it evolves, and then that's how the Fed will determine what the Fed is going to do with the interest rates, and that's how we will be able to determine what's going to unfold going forward in the market. So there are other factors also, quarterly results from various companies. Like even despite this market being where it is, I bet that when Tesla announces its results next week, we may probably see a bit of a spike out there, because that's a good news story. However, that will be short-lived because of the overall factors in the market. But some good quarterly results, like if Microsoft, Tesla, and Apple, all of these come up with good results and also project a good quarter ahead, then that can kind of help the market recover a bit despite all these factors. But such recovery might likely be a short-lived one until the core issues of the economy get solved. When there is no longer an appetite to sell shares, when people are tired of selling shares and they have had enough, that's the other point of time when the market will have reached its bottom, because it will no longer be of any interest for anyone to sell. They're all beaten down, and at that time the market volumes will be very, very low. That will be the signal that people are really tired of everything, and then subsequently if anything happens, that will be on the way up. So that's my thought process on how low the bottom can go and when it can go. And as I mentioned earlier, having seen this video and potentially the two videos that I have linked up here, you might also have much more comfort in interpreting what is happening in the market in terms of reports on consumer price index, in terms of report on employment status, in terms of report on supply chain issues, in terms of quarterly company reports on how they view the next 3 months from their point of view. All these things, when you look at them, you'll get an idea of how the market is going to react, and you can take much better positions. So this is my hope with this particular video, and I hope you find some value in this. And once again, these are my personal opinions based on my own research. Please do your own due diligence before making any investment decisions. And thanks for watching this video. Thanks for all the likes that you put on the video. It makes it reach to many other people who have not seen these videos before. And I hope you have a wonderful weekend. Bye for now. See you in the next session.